Financing options for investors. There's a lot to this topic, so I'm going to try to break it up into just a 3 or 4 minute video real quick and just kind of hit the overcap 20,000 foot view, okay? I do seminars and teach this class on a regular basis. You'll have to reach out to me for more info or come to one of my classes is the best way to do it. Real Estate Investor Network, Nashville, REINTN.com. Get on their website, check out their calendar. They have events all the time. And you're going to learn everything you need to know about investing properties and all the different ways there are to make residual income in real estate and provide a good financial foundation for your family and your children's children. Okay, so let's talk about basically there's I'm going to say there's 5 different ways, good smart ways to finance an investment deal. Now, every deal is going to be different. You're not going to plug all of them in, but I'm just going to kind of give you the breakdown, the high-level overview on each one. So I'm going to hit the 5 real quick. So you got hard money, you've got private money, you've got a self-directed 401k, you've got non-QM mortgage, and then 5th, you've got a conforming conventional mortgage. Okay, so let's talk about hard money first. What hard money is usually it's a pool of private individuals that will get together. It could be institutional money from hedge funds or mutual funds, but more than likely it's usually a couple private individuals that'll put a couple $1,000,000 into a pot, and then they will loan that money out to you for a higher return. Usually hard money, you're going to see interest rates I have seen as low as 10%, as high as 15, 16%, and usually they're going to charge you anywhere between 2 to 4 points. What a point is it's 1% of the loan amount. So for easy numbers, if it's a $100,000 loan and it's 1 point, you're going to pay $1,000 in additional closing costs. If it's 2 points, you're going to pay $2,000. And that's really how the lenders make their money on the points. They really don't make as much in interest because the interest on hard money loans usually is going back to repay their investors who kicked in all the money. So hard money, high level overview. Private money. That could be like your father, your rich uncle, somebody that you're getting private money from. Whatever the terms are, you guys negotiate what you're going to get private money. Great source if you've got access to somebody, if you got a rich uncle, okay? Number 3, a self-directed IRA. I am not a CPA, accountant, or a financial planner, so I can't talk very deeply about it, but ask your CPA about doing a self-directed IRA. Also, Google it. There is a ton of information out there. Self-directed IRA, basically in a nutshell, you can take your 401k and invest that in whatever you want to invest it in as long as it's a qualified investment. So there's a list of what makes qualified investment. Guess what? Real estate is considered a qualified investment. So you can pull all the money from your 401k. It has to be directed by a custodian, and then you can determine what that money goes towards. So if you want to buy real estate, you can use that money as your down payment, or you can just pay cash for the whole thing if you've got enough money in your 401k. I'm a huge fan of a self-directed IRA, but I want to tell you this, your financial planner is not going to be a fan of you pulling all your money out of your 401k to go invest in real estate, because not only is that his livelihood, it goes against everything he was ever taught. Okay, financial planners do not like that idea. I'm just giving you a heads up. It's going to be a battle. Maybe not, hopefully not, if you got a good financial planner. Number 4, non-QM loans. What a non-QM mortgage is it's basically, it's usually backed by a hedge fund or some of these institutional investors with a lot of money, and they do loans that don't necessarily meet the Fannie Mae, Freddie Mac guidelines. The best loan for investors is called an investor cash flow loan, or also a DSCR, which stands for debt service coverage ratio. I've got videos on that. That's kind of the loan that I specialize in between that and a commercial loan. But in a nutshell, the DSCR loan is great for investors who own multiple properties. You're over the conforming limits, or you write off everything on your taxes as any good American self-employed person will do, and you don't show as much income on your taxes. I can still help you buy investment property without even looking at your taxes. You still have to have your 20% down, which most of these loans want 20 to 30% down, kind of depending. And then number 5 is a conforming mortgage. This is your Fannie Mae, Freddie Mac 30-year fixed with low interest rates, okay? Non-QM mortgages also are 30-year fixed. The rates are about a 1% higher or so than a conforming mortgage. But a conforming mortgage, if you qualify, if you can fit in that bucket for a conventional mortgage, it's usually the best long-term money. The QM, the non-QM loan, and the conventional loan Those are for long-term buy and holds. They're not for short-term flips. Short-term flips, you're going to want hard money, self-directed IRA, or private money. But if you're going to hold it long-term, talk to me about a non-QM loan. I'm more of your long-term guy. I've got resources for you for short-term money. It's just not what I specialize in. There are a lot of people that do it very well, and I would be glad to connect you with them, and I'll be glad to answer any questions I can in general. But if you're looking to buy and hold long-term, I've got 30-year fixed options that is going to be hands down the best bet, because you want to get that money secured for a long period of time with a low interest rate over a 30-year period, and just let the tenants pay that mortgage for you. So hopefully this helps you guys. 20,000 foot view.